The US dollar index has pushed above 101.50, and if you hold Korean equity exposure, that number is working against you right now. Here is why that matters. The driver is straightforward. Markets are pushing out Fed rate cut expectations, and US economic data continues to outperform its peers. That relative strength is the fuel behind sustained dollar dominance. As the dollar rises, the Korean won weakens, and that FX gap cuts directly into the dollar-converted earnings of Korea's three export pillars: semiconductors, autos, and petrochemicals. The mechanism is this. A chipmaker like Samsung or SK Hynix books revenue in dollars but carries costs in won. When the won depreciates, local margins can look flattering, but dollar-denominated investors see compressed real returns and rising hedging costs. Layer in the debt angle. Korean corporates carry significant foreign currency borrowing, and a weaker won means the won equivalent repayment burden rises with every tick lower. The commodity signal reinforces this. Gold has fallen to a 2-week low, silver is also declining. Safe haven demand is fading. This dollar bid is risk-on, not fear-driven, which means it could persist. Broader emerging market currencies are weakening in tandem, and capital is rotating back toward US assets. If you hold EWI, the iShares MSCI South Korea ETF, or global semiconductor names with heavy Korea revenue, check your unhedged FX exposure today. This will not show up in earnings until next quarter. Also, watch the Bank of Korea. If the won keeps sliding, the central bank faces a difficult choice between intervening to defend the currency or holding rates. Either path constrains domestic growth. A DXY above 101.50 is a margin squeeze, a debt burden, and a capital flow headwind hitting Korea's export economy simultaneously.